Okay, good morning and welcome back everyone to our Tuesday morning market outlook session. My name is Tony Zhang. I'm the chief strategist here at OptionsPlay. And I just want to say before we start a big thank you to all of our members who have spent the time to fill out our recent survey about our different events that we host each week and the feedback that you guys have provided. We have already incorporated some of that feedback into today's session. We're going to continue doing what you guys have responded well to, and we're going to make some adjustments as we continue to go along. But I just want to say a big thank you, and hopefully this session will be improved for the topics that you guys have particularly liked. So before we get started, what we are going to discuss here today is purely for education and demonstration purposes. It is not a solicitation or recommendation to buy or sell any specific securities. We're going to start off with our major equity indices to take a look at where they currently sit and how we're viewing them before taking a look at the fixed income markets, where we continue to see the dollar move quite a bit here, but perhaps not in the way that we're expecting to, and the ramifications that has on treasuries as well as commodities like gold. We're going to spend a bit of time on sector rotation because a lot of you have given feedback that you really like the sector rotation model. So we're actually going to spend a little bit more time looking at the sectors that are moving, what direction they're moving in, taking a look at individual sectors that currently make or either breaking out or breaking down. And then we'll take a look at, we'll continue what we started last week, which is looking at more stocks that are breaking out and more stocks that are breaking down, as a lot of you have given feedback that you really like that section. So we're going to continue with that. So let's start off with the major equity indices here. The S&P 500 remains on its strong upward trajectory. That has not changed. What's even crazy is the fact that we've had 4 sessions down and then made that back up in 3 sessions. Usually markets fall much faster and take a bit of time to get themselves back to break even, but we've seen actually a move back to break even faster than the move here to the downside. So we still very much are remaining in this upward trend, if you will. Pullbacks tend to be a little shallower here, but we're back up near the top end of the range here. So we're back near that resistance level, perhaps seeing a little bit more of a grind as we've seen here before. We see a similar type pullbacks here and then a continuation higher. That's the market environment that we are in. Nothing has changed from that despite the sell-off. The sell-off did test this support level here, held that support so far. So the upward trend remains intact. Same thing for the NASDAQ 100 index. Breaking below some minor support levels, but very, very quickly breaking back to new all-time highs. So the upward trajectory here of the NASDAQ 100 remains very much entrenched, but again, higher highs in price, same divergence, lower lows in momentum. So this certainly continues to kind of perpetuate this grind higher here, followed by small pullbacks, which is what we have seen in this particular market. But the Russell 2000 small caps remains fairly negative here in terms of momentum. As you can see, the trading range that the Russell 2000 has been trading between 210 and 235 or so. The Russell 2000 is still near the bottom end of the range, nowhere near back towards all-time highs that the S&P and the NASDAQ are in. So the small caps, still has this gap fill to contend with around 221 or so, has major resistance here around 224 or so. It would really need to get back above both of those levels before small caps can be tested here again. But in my opinion, more likely we might see a retest of this 210 support level before we see a retest of that 235 all-time high here for small caps. And then when we look at RSP equal weight S&P 500, market breadth does improve. However, it's still roughly where we were back here on the March 5th highs. So while market breadth is improving, meaning the number of stocks that are participating on this rally is improving, it is nowhere near where it really needs to be, in my opinion, to confirm these new highs that the S&P and the NASDAQ 100 are continuing to make here. So not a lot has changed in terms of the health of the market. It's still fairly unhealthy, meaning you just have a few major stocks like Microsoft, Apple, NVDA, Google continuing to blaze this trail higher, if you will, while the rest of the market largely is trading sideways or some even continuing to break down to the downside here. So that has not changed the current market conditions, but things are not bad enough, if you will, for this to break just yet. And keep in mind, just because things are bad does not mean that things are going to turn downward. It doesn't mean that the markets are going to turn bearish. Things can start to improve, and we have seen some of that improvement here over the past couple of weeks, just not quite enough, in my opinion, to say that we can now confirm these new highs. If we look at EEM, emerging markets, this is really where we've seen this breakdown here below 51 over the past week or so. This level was tested briefly a couple of weeks ago, but held. But now we've fully broken below this. We've come back to retest this level near this resistance level. And the question is whether this continues to move lower here or not. So this is the trend line that we're really paying attention to here. If we test this trend line and start to bounce lower here, that certainly puts international equities back at risk. But there are certainly still some concerns at the moment as to how these emerging markets are shaping up. You look at South Korea, you look at Taiwan, you look at China, a lot of these are falling, through some support levels, especially South Korea. So international equity is not looking as strong. And then domestically, if you look at growth versus value, growth yesterday broke out to a new all-time high. Same issues that we see with the S&P 500, new highs not being confirmed by momentum. Market conditions are not particularly healthy, but they continue in this upward trend, upward to the right. Now, when we switch over to looking at the dollar recently tried to break out above this resistance level, this 93 and a half resistance zone, if you will. So far failed to really hold those levels on the breakout. I wouldn't say that this is a failed breakout yet. I still think that there could be another attempt to break higher here, but this is one that we're going to pay attention to. If it can get back above 93 and 93 and a half, that's the zone that it really needs to clear in order for the dollar to continue moving higher here. This is going to be tied to the Fed meeting in terms of whether or not they're going to reduce bond purchases or not, as to what the dollar can rally, and that's going to have ramifications on things like TLT. So far, TLT remains holding above this 146 level, so very much range bound between 146 and 152 or so. We're near the top end of the range here at the moment. Perhaps we could see a bit of a pullback here, but largely our expectations here for treasuries is still going to be more neutral and range bound rather than significantly higher, unless we could clear back above 152. And that's going to keep interest rates here around this 125, 126 basis point level here. It's really found a bit of equilibrium. Despite having some big moves up and down from this level, this 125 has been kind of the new normal, if you will, since the beginning of July or so. So this is one that we're going to continue to watch, and this is the trend line that we're going to continue to watch to see if we have a retest and potentially a bounce lower here in terms of yields. And gold did recently clear back above this gap fill level around 150, 167, 168 here or so. So right now you still have one other gap fill level here around 171 and a half. If it can get back above that level, then we're off to the races here into the 178, 180 level here. From my perspective, momentum still remains negative here. So this is going to be, I think, a big hurdle to clear for gold to get back above 171 and a half. And this is one that we're going to have to watch right now. Gold is going to trade in a fairly tight range between 168 and 171 and a half. And we're going to have to see whether it breaks out higher here or resumes back into the overall trend. And keep in mind, if you look at the gold over the overall trend, as you can see, very much here to the downside. So this is one that you should keep in mind of the longer term trend, which is still very much the downside. But like I said, if we can break above 171 and a half, that starts to put this downtrend into potential reversal category where this could start reversing higher. Now, looking at sector rotation, this is one of the pieces of feedback that everyone has provided, that you guys love this section and that you want us to spend a little bit more time. So we did spend a bit of time to try to improve this so that you get more out of the sector rotation chart. So far, what we have here is 7 sectors that are improving and leading and 4 sectors that are lagging and weakening. So more sectors improving than weakening. If we look at the leading sector right now, we have 5 sectors in the leading sector, of which you have healthcare and staples, which is actually recently moving from weakening and improving into the leading categories. So staples and healthcare leading this charge higher here, while you have financials, financials, utilities, and materials that are leading, but starting to lose some momentum and get back into the weakening category here at the moment. So 5 sectors in the leading category, 2 moving towards leading, 3 moving away from leading. There's no sectors right now currently in the weakening category right now. If you look at the lagging category, we have energy that has recently entered the lagging category from the improving category. So energy losing quite a bit of ground here and now back into the lagging category after spending quite a bit of time in the improving category. And then you have discretionary, you have real estate, and you have technology all starting to improve, not quite there into the improving category yet, but hopefully in the next couple of trading sessions, we'll start to see technology, real estate, and discretionary move back into the improving category. And then within improving, you have communications and industrials. You have communications that recently just entered improving, and then you have industrials that has been in improving, but starting to move towards the lagging category. So that's just a breakdown here of the 11 sectors and where they currently sit and how the overall market is looking in relation to that. So let's take a look at some of those sectors. I talked about XLI failing to really break out and starting to back towards the weakening category. Industrials attempting to break out higher above this 104.5 chart, 104.5 level here, but so far failing to really hold that level. So this is kind of a bit of a failed breakout here and potentially still back into this trading range here for XLI. So lack of momentum, lack of relative strength here for industrials. Not quite there yet. Technology, big move here to the upside here from technology, breaking out to new all-time highs. So a lot of strength here for technology at the moment. Real estate also attempting to break out higher here, not quite there, but very much still in this upward trend here, just grinding its way higher here. So real estate still looking fairly strong here, but not a ton of momentum here to the upside. Here's a very interesting chart here is consumer discretionary. Consumer discretionary is improving, but I want to make sure that we pay attention to this level. This is a key level. If this level can break out higher here, then we're back towards 184 and potentially back to new all-time highs. But if this level fails at this 184 and we start to reverse lower here, that's where we can see consumer discretionary pull back to this 174 level. And we're going to take a look at some discretionary names today, some big ones that are starting to show some weakness here. So this is one that's going to be one that we want to pay attention to is discretionary. And then looking at some of the economics, I've been talking about this quite a bit, about the fact that over the past year or so, we've seen manufacturing rebound extremely positively after the steep decline that we saw during the pandemic, and manufacturing has remained extremely strong here. And over the past month, we've seen a bit of a slowdown here in manufacturing, but still remains at a decade high level here in terms of manufacturing. But one of the concerns that we've always had was that services needed to catch up and remain strong here for the economy to really get back. But we're starting to see services come down substantially here in terms of recovery. So services is kind of back to pre-pandemic normal rather than kind of the elevated levels that we continue to see here on the manufacturing side. So this is one that we really have to pay attention to, because this is going to continue to revise the growth trajectory that we're expecting here in the second half, whether that can continue at the same pace or at least remain fairly elevated. And if we start to see services come down significantly and manufacturing starting to come down a little, that's going to start putting, again, the second half growth cycle into some jeopardy. And that's really kind of the angst that we continue to see here from the equity markets, and why we haven't really seen the equity markets progress very much here over the past month, 2 months, as the Delta variant continues to be an issue here. And another thing that I want to point us to is this continued debate of inflation, whether this inflation is transitory or permanent. And we have more data to show us that this inflation is not by any means resolving itself just yet. Input prices for manufacturing continue to rise. There's been a deceleration, but it continues to rise. But most importantly, I think, when we refer to inflation, is the output prices, meaning manufacturers that it's costing them more to manufacture, pressure. So they're actually increasing the prices of what they are selling. This is the impact to inflation that we as consumers actually feel as the price of the goods that we purchase continue to rise, because the input cost for manufacturing them are continuing to rise. So we're seeing this on both sides, the input and the output side. It's not like manufacturing right now are eating the cost. They might be eating some of it, but they are still passing on largely most of that onto consumers. And usually there's a lag between output and input prices. So this is one where the debate still remains very much, at least in my camp, shifting more towards the permanent side of things than the market is really anticipating or pricing in at the very moment. So with that, let's take a look at some of the stocks that are starting to break out higher here on strong relative strength, and the stocks that are breaking lower here on relatively weak relative strength. So one of the big movers in this market is going to be NVIDIA yesterday on very strong volume. NVIDIA, one of the strongest stocks here in the semiconductor space, one that we've talked about heavily in our rapid fire sessions, in some of our other sessions, after consolidating for a bit of time, breaking out yesterday on high volume. So this is one, it's a strong confirmation of this breakout on that high volume with strong relative strength, with a stock that has very strong fundamentals and outlooks, even though it trades at very rich valuations. The next one I want to put on your watch list is Comcast. A fairly tough Olympics, I would say, here for Comcast. But as you can see, trading itself into a wedge and potentially breaking itself out of this wedge here to the upside. Not quite just there yet, and not a lot of volume just yet, but I think this is one worth paying attention to and putting on your watch list. If we see a breakout here above $60, that would put it back towards new all-time highs and continue higher here. But it did close above its previous all-time high yesterday, and we're likely going to see a continuation here today if equity markets remain strong. And then looking at the healthcare space, one of the sectors that has been extremely strong here is AstraZeneca. AstraZeneca recently breaking out above this 58.5, 58 3/4 level, breaking out, coming back to retest this level as support, and potentially a stepping stone, if you will, towards the $61 recent highs and potentially to new highs above that level. So a risk reward, being patient, not chasing that breakout, is coming back to retest this level as support, and I think is a better attractive entry point for a long in the healthcare space. Another pharmaceutical is Sanofi, not one that we talk about here a lot, but this is a stock that has a very strong run here from March to June or so, from that 45.5 to about 55 or so, and spent the last couple of months consolidating, and just just last week broke out higher here. It's starting to come back to test this level as support, and potentially can get back towards this 54.5, 55 recent highs, and potentially significantly higher above that if it can get back above those levels. But certainly the breakout, the consolidation pattern has now been completed. We now have the breakout and could see this back towards that 54.5 level. Another one that I think is worth paying attention to is Procter & Gamble. Now, Procter & Gamble has not broken out yet, but this is by far the largest by weight in the XLP sector. Procter & Gamble is almost twice as large as Coca-Cola in terms of market cap. So if this breaks out above 146, we could see some significant upside here. It's not there yet, but this is one that I think we need to put on our radar and on our watch list for that potential breakout here, as Staples remains fairly strong. And a slightly different one, not a breakout one, but perhaps an early warning signal, if you will. Delta Airlines putting in a triple bottom here around this $38 level. Triple bottom coupled with improving momentum here. So you have positive divergence, new lows, new highs on divergence, on momentum. So what you have is a very strong downtrend here that is near the apex here. We've started to see this triple bottom form. And what we really would like to see is the breakout from this trend line. We'd like to see a retest of this $41 level here. And then once we break out above that $41 level, we can then call this bottoming formation complete, and for Delta Airlines to start improving from here. So this is the very early innings of what looks like the completion of a bottoming formation. It is very early, but this is one that I think is time to start watching as airlines start to recover a little bit. And on the flip side, looking at some of the main leaders, if you will, of this recovery that is starting to show some weakness here. We've showed you American Express from last week, very similar chart, strong uptrend, started to break below those trend lines. Target, one of the strongest beneficiaries of the pandemic, from $90 stock to $260 stock, has now broken below this major trend line, has come back to retest that level as resistance, and yesterday so far is holding that resistance level. So this is not quite, I would say, bearish here for Target just yet. I would like to see a break below 245 before we say that this topping formation is complete, but we certainly have the early innings of what looks like a topping formation. We could very well see a bit more of a neutral move before this breaks down, but this is one that I'm watching here for Target to break down lower here below this 245 level, because this certainly starts to look a bit like a topping formation now that we've broken below this major trend line. Looking at another weak stock with weak relative strength, AT&T. A lot of investors have this stock in their portfolios, including myself. A lot of them liking the dividend yield, the 8% dividend yield, but this is starting to break below 27.5 support here. Again, you know, we've broken below quite a few major support levels here this year, 28.5 being that first major support level. Now we've broken below 27.5 support level here. So this really puts 26.5 back into contention here to the downside. Many investors may not care when you get 8% dividend yield, but it's still important to pay attention to when the stock starts to break down. AT&T's debt loads, while extremely high, is still being serviced here at the moment from cash flows. But the more this starts to get put under pressure, the more that dividend yield is going to become an issue here. So AT&T, one to start watching for. General Motors also completing a topping formation here around $50 here or so. So we've had this multi-month topping formation that's now broken below this level. Now, there hasn't been a lot of trading between $40 and $50 because we basically broke out from 40, came back to retest it, quickly broke back above 50 and just traded above 50 this whole time. So you have a bit of a vacuum here between 40 and 50. So this is potentially at risk of getting back into that $40 level here to the downside. There's some minor support here around 46.5 or so. I'm not sure that there's a ton of support here around here. So this is one that I would really watch, because a break below 46, like I said, would bring us back down to the $40 level. If we can break back above 50, that would be constructive, and we very well could. But this is one where I think that perhaps downside is more likely here at the moment for General Motors, especially as we start to see even some of the best planned car companies like Toyota Motors is starting to see some downside here, especially as the chip shortages. I would say Toyota Motors is probably by far the best planned in terms of chip shortages, and even they're continuing to show some downside here. So I think some of these other major car players are going to continue to get squeezed as a result, and General Motors and Ford is by no means insulated from that as well. If you look at Zoom video, this is a minor support level that recently Zoom broke below, but this is one also worth paying attention to. It's the 345, 340 level here or so. We broke below it. We're back to retesting it as resistance. And the question is whether if that holds and starts to trade lower here. Zoom, continues to trade at, I would say, fairly rich valuations, despite the fact that the business model seemingly has stabilized a little bit. But if you look at the long-term trend, it still very much remains in this downtrend here. There's no doubt about that. We're in this kind of down channel. It very well could break out above this down channel and start resuming its move higher here. That's one that we have yet to see that breakout. But so far, the fact that we've broken below support and is now starting to retest it as resistance potentially could mean further downside here for Zoom. And then lastly, looking at Rio Tinto, this is one of the material stocks, mining stocks. Also similar type of formation to General Motors. You have the breakout here above the $73 level. It's retested this level as support multiple times and is starting to break below this level. So the fact that we've broken below, coming back to retest this level as resistance, this is not only only a resistance level, but also a gap fill level here. This could mean Rio Tinto starts to see trends back down to the $60 level here to the downside after it completes what looks like a major topping formation here after what has been a very strong run here to the upside. But this level is now starting to get tested, and we could see a pullback towards that 200-week moving average, which comes in around 65 or so. So those are the stocks that we're currently paying attention to, stocks that are either breaking out on strong relative strength or breaking down here on weak relative strength, giving you more ideas to look at, to research for your trading day, and hopefully giving you a little bit more understanding as to a deep dive into that sector rotation chart, as many of you have asked about more sector rotation, knowing which sectors are moving and giving you individual stocks that are moving within each sector. So with that, I want to thank you for your time here this morning. I hope that this was helpful in giving you a better understanding of the broader market and some of the ideas that we are paying attention to here in the broader markets. And again, thank you so much for all of you that filled out the survey here last week or over the weekend regarding our events. We are taking in your feedback live every single day and making sure that we incorporate them into the events that we do. And hopefully this is a shift in the right direction, at least for the market outlooks. We'll continue to do that on the Thursday afternoon and education sessions, as well as the Friday rapid fire and thematic investment series. We got a lot of great feedback on those two sessions, and we'll be making some changes to the rapid fire and the thematic session to make them more aligned with your feedback. Thank you so much, and I hope you guys have a great trading day. We will send out this recording to you guys in an email with the sector rotation chart and the notes for the sector rotation, as many of you said that you really like that information. So with that, thank you so much and have a great trading day.